Hey, and welcome to Margin Snowball. This is week 1 of documenting my real-time strategy using margin on M1 Finance to try and accelerate long-term compounding. Quick background about myself. I've been investing for about 15 years now. I invest in stocks, options, crypto, and real estate. I have multiple brokerage accounts for investing in individual stocks and options. Plus, I have exposure to crypto and real estate. But this channel focuses on one thing only: using M1 margin to build a sustainable income-generating system to supercharge the growth of my portfolio. Let's get into it. Here's how the portfolio is structured. My main portfolio is fully cash funded and currently worth $20,000. It's made up of VOO, which tracks the S&P 500, QQQM, which tracks the Nasdaq 100, and IWM, which tracks the Russell 2000. This core portfolio is long-term and low maintenance, but more importantly, it acts as collateral for my margin loan. M1 allows margin borrowing on taxable accounts up to 100% of your portfolio value. So I'm not selling anything, I'm using the main portfolio as a borrowing base to create a second portfolio, the income portfolio. Right now, the income portfolio sits at about $6,500, and that's fully funded with borrowed money. It's made up of just 2 positions. About 70% is in SPYI, which generates income by selling covered calls on the S&P 500, and the remaining 30% is in QQQI, which does the same thing but based on the Nasdaq 100. Both are designed to produce steady income, which is exactly what I'm aiming for with this part of the portfolio. So far, I've used $7,000 of margin. Here's where the risk metrics stand right now. Loan to value, or LTV, is sitting at 32%. That's just a measure of how much I borrowed relative to the total value of the portfolio. To give you an idea, if your account is worth $20,000 and you've borrowed $5,000, your LTV would be 25%. The lower the LTV, the less leveraged you are, and the more room you have before hitting a margin call. I aim to stay under 35% LTV with a hard stop at 40%. That gives me a margin of safety, no pun intended. Now on to margin health, which is currently at 61%. What that means is the main portfolio would need to drop by 61% before I get margin called. A margin call is basically when the broker steps in because the value of your portfolio isn't high enough to support the amount you borrowed. At that point, they can either liquidate some of your positions or ask you to deposit more cash. In my case, since the loan size is still relatively small, just $7,000, I've got plenty of cash reserves on the side in case I ever need to plug a hole. So even in the worst case scenario, I'm not at risk of being forced to sell. That said, as the portfolio grows, that margin exposure will naturally become more significant. Once the total value starts approaching the $100,000 mark, I plan to dial things back. Reduce the leverage, rebalance, and de-risk the setup. Bigger portfolios are harder to move quickly in a downturn, so I want to stay ahead of that curve. Alright, here's what I actually did this week. I took out my first margin loan, $6,500, and used that to buy into the income portfolio. I picked up 86 shares of SPYI and 35 shares of QQQI, which now make up the full portfolio. On the main portfolio side, I also added $2,050 to dollar cost averaging. Just continuing to build that up slowly with cash. No dividends came in yet, but those distributions should start hitting by the end of the month, so I'll be tracking those closely going forward. Let's take a quick look at what happened in the markets last week. The S&P 500 was down about 1.6% and the Nasdaq dropped even harder, just over 3%. In the income portfolio, SPYI was down 1.2% and QQQI fell 2.5%. Meanwhile, in the main portfolio, VOO dropped 1.6%, QQQM fell 3%, and IWM was down 1.7%. Now I'm also keeping a close eye on the VIX, which closed the week at 19. That's not high yet, but it's getting closer to the level where things start to get interesting. So here's why I care about the VIX. It's basically a short-term volatility gauge, kind of like the market's fear meter. When the VIX spikes, it usually means there's selling pressure, and that's often when I want to be a buyer. My strategy actually leans into that. When the VIX jumps, I look to borrow more and buy while the prices are lower. But it only works if I have room, because when markets drop, so does my collateral. That pushes my loan to value up and tightens the margin safety net. So it becomes a trade-off. I want to buy the dip, but I don't want to over-leverage and blow the structure. That's why I track the VIX, not to avoid action, but to take smarter action when the timing is right. Now let's talk about the cash flow side of the strategy. This is where the snowball effect really starts. Right now, The income portfolio is sitting at around $7,000, fully built with margin. Based on current yields, that setup is expected to generate about $840 per year, which averages out to roughly $70 a month. The cost to borrow that $7,000, thanks to my current promo rate of 4.4%, comes out to about $25 per month in interest. So after covering that, I'm left with $45 in net income each month. And here's where it gets interesting. That $45 doesn't just sit there. I reinvest it straight back into the main portfolio, which increases the overall value, lowers my loan to value, and improves the margin health. That in turn frees up more room to borrow. So the cycle looks like this. Grow the main portfolio, borrow more against it, invest that into the income portfolio, and use the income it generates to grow the main portfolio again. That's the snowball. It's a controlled loop. Use margin to generate cash flow, and use that cash flow to strengthen the foundation. Let's talk about why I chose SPYI and QQQI for the income portfolio, especially when there are ETFs out there flashing way higher yields. You've probably seen those yield max funds offering 70% plus annual yields. Sounds tempting, right? But I stay away from them, and here's why. SPYI and QQQI run a broad index covered call strategy. They track the S&P 500 and Nasdaq 100. That means they generate income by selling options on diversified indexes, which helps keep their net asset value, or NAV, relatively stable. Even when markets get choppy, the underlying structure holds up. Compare that to the yield max ETFs, which sell options on single stocks like Tesla or Nvidia. Those can generate big payouts short term, but they also bleed capital fast. It's not unusual to see 50 to 80% NAV erosion in a single year. The income's high, but it comes from slowly killing the fund. Another reason, SPYI and QQQI can actually grow in bull markets. Covered calls do cap some of the upside, but not all of it. And because they're based on indexes, they still have room to appreciate. That's key for compounding. Yield max funds, on the other hand, almost never grow. They're built for short-term yield extraction, not long-term portfolio building. Not what I want for a snowball. So yeah, the yields on SPYI and QQQI are lower, around 10 to 12% annually, but they come with stability, capital preservation, and the potential for NAV growth, all of which are crucial when you're using margin. Bottom line, my goal is to scale income over time, not torch capital chasing flashy numbers. So what's the big takeaway from this week? Margin isn't dangerous, it's just misunderstood. Used the right way, it's not some high-stakes gamble. It can actually be a growth engine as long as you manage it with discipline. Here's how I'm approaching it. I'm building off a base of safe, diversified assets like VOO, QQQM, and IWM. I'm keeping my loan-to-value at a conservative 35%. I've added a yield engine, SPYI and QQQI, to generate steady income. And I'm reinvesting that income right back into the core portfolio. All of it is rules-based, no emotion, just inputs, outputs, and calculated risk. Now looking ahead to this next week, here's the plan. On the main portfolio side, I'll be investing $1,050 in total. That includes the usual $150 weekly DCA, but I'm holding back $100 from that to cover future margin interest. Then adding another $1,000 as part of the ramp-up plan I'm running for the next 6 months or so to aggressively grow the main portfolio. For the income portfolio, I'll deploy the $500 I borrowed last Friday. And if the VIX pops above 20, and my LTV is still under 35%, I may borrow a bit more and put that to work as well. The system is simple. Fund the machine, monitor the risk, and reinvest the output. That's the strategy, and the snowball keeps rolling. That wraps up week 1 of Margin Snowball. Every week I'll break down what changed. Portfolio values, income, margin usage, and the risk profile behind it. If you want to follow the compounding process in real time, subscribe to the channel so you don't miss the next update. Drop a comment if you have questions about margin, M1 Finance, or any of the funds I'm using. I'm happy to answer and share everything I learn along the way. No hype, no fluff, just a real strategy tracked weekly. And please remember, this content is for informational and entertainment purposes only. It is not financial advice. Always do your own research before making investment decisions.